Congratulations, you've made it to week 4. Can you believe you've gotten this far on your journey to home ownership? So far, you have reviewed your credit report, narrowed down your home search criteria, maybe even attended some open houses, set a plan for the home purchase by completing your roadmap, and signed up for a home counseling program. Wow. Now, for week 4, we are focusing on getting a general understanding of different loan types. Please be advised, we are not certified loan officers, and this is just a general overview of loan types based on our professional experience representing buyers. Specific questions should be directed to a loan officer. We are at the stage where many first-time homebuyers become very nervous. It's time to apply for a pre-approval. But what type of loan should you apply for? Think your score is too low? Want to have more money saved? It's actually a good idea to contact the lender the moment you decide you'd like to buy a home, even if you don't think you're ready. This is because a good loan officer will review your finances, credit score, and your home criteria to help you determine the best mortgage product options available and or help you to create a plan if you need to put a few more things in place before you are ready to move forward. Some banks also have home buying assistance funds for qualified buyers. After speaking with the loan officer, many people often realize they are in a better position than they initially thought, or they are able to have a better plan to home ownership than if they were to try to do it on their own. A loan officer will review your profile with you and help you identify special loan programs that meet your financial and home ownership goals. When thinking about a home mortgage, we have to think about the components that make up your monthly mortgage payment. 1. Principal and interest. The principal is what you're paying towards the loan. The interest is what the bank charges you on top of the principal loan balance. 2. Property taxes. This is something many buyers don't realize. When you're looking for a home, look at the property taxes. The annual property tax amount is divided throughout the year and added to your mortgage. Regardless of whether you rent or own, if you have a property, the owner must pay property taxes. If you're renting, you're covering your landlord's property taxes with your monthly rent. As an owner, your mortgage will include the property taxes. The higher your property taxes, the higher your mortgage. Property taxes are especially higher in the counties surrounding Philadelphia, so pay close attention when house shopping. 3. Homeowners insurance. You must carry homeowners insurance for your property, just as you do for your car. The higher your insurance, the higher your mortgage. This is something you can control. Shop around for mortgage quotes and have them ready for when you find the right home, as your lender will require your homeowner insurance information once you're under contract. Finding a good but affordable homeowners insurance policy can help to keep your mortgage low. If you wait until the last minute once you're under contract, you miss the opportunity to effectively shop for the best and lowest rate. In addition, ask your insurance policyholder if they have discounts for homes with special features such as a newer roof, HVAC system, etc. 4. Lastly, mortgage insurance. Mortgage insurance is the premium lenders charge when a buyer puts less than 20% down on a home. Putting less than 20% down on a home increases the bank's liability as they have loaned a large percentage for the purchase of the home. Therefore, in the event a buyer defaults on a loan, the mortgage insurance collected by the lender helps to offset the remaining balance of the mortgage. However, the good news is that there are many more loan products that offer no or reduced mortgage insurance, although a buyer would have to meet certain criteria to qualify. Now that we understand the parts of a mortgage, let's discuss a few of the main home mortgage types. FHA is a common government-backed mortgage due to its low down payment requirements and low minimum credit score. Because FHA is a government-backed loan, its guidelines will be the same regardless of the bank you choose to secure the mortgage from. Some key points that make this loan attractive are 3.5% minimum down payment, minimum 580 credit score, up to 6% seller's assistance allowed towards buyer's closing costs. Gift funds are allowed towards buyer's closing costs. Now, there are two major requirements of FHA mortgage that makes this less favorable. One, a required upfront and monthly private mortgage insurance. This makes both your monthly mortgage and closing costs more expensive because FHA has one of the highest mortgage insurance rates. Two, condition requirements. An appraisal of a property being purchased with a FHA loan can be more difficult than one being purchased with a conventional mortgage because of the condition requirements. FHA homes must meet HUD condition guidelines, and funding will not occur unless any cited repairs are made. This can make an offer presented by a buyer using FHA a bit less appealing to sellers and or their listing agents because they may not be willing to do FHA required repairs. Homes that need updating will have some issues cited by the FHA appraiser. Conventional loan types typically have more flexible criteria. There are tons of different types of conventional loans, some even unique to certain banks. Many banks are able to create their own conventional products that they think will fit the needs of prospective buyers. There are first time homebuyer mortgages with only 3% down payments and no mortgage insurance. There are also renovation loans for buyers who wish to buy a fixer upper, and many, many more. Conventional loans usually have a minimum of 3 to 5% down payment depending on the loan requirements, have a bit more flexibility with property conditions, and have no or reduced mortgage insurance. However, the minimum credit score is 620 for approval and a lower debt to income ratio than what is allowed for FHA. VA and USDA are two other government-backed loans. VA loans are for veterans. USDA loans are for buyers looking in specific USDA-approved rural areas. Both of these are 100% loans, which means no down payment is required. There are USDA-approved areas in Montgomery and Chester counties, as well as parts of Delaware. Now you should have a better understanding of what makes up your monthly mortgage payment, as well as the difference between some common mortgages. Both your home counseling workshop and your loan officer will provide more detail with understanding your mortgage. Are you ready for your homework? Your tasks this week are to 1. Contact at least 3 insurance companies and ask for quotes. You can provide an address of your favorite property from a home search website or give the zip code of where you'd like to move. This will help you determine who you may want to use for your mortgage insurance once you find your home. Trust me, doing this now, before you really get into the process of shopping for your home, will be a burden lifted. 2. Review the sample estimate of closing costs. 3. Read the 10 rules when applying for a real estate loan found in your home buying packet from week 2. 4. Schedule a one-on-one appointment with us. This week we will begin holding one-on-one planning sessions with Academy participants. We are halfway through our home buying workshop and want you to solidify your plan towards home ownership. If you would like a personalized plan, schedule your one-on-one using the Google Doc link that will be provided to you. Complete and submit your buyer's financial information sheet. Review, sign, and submit the buyer agency agreement. Solidifying the Sarita Brown team's representation of you as your realtor. Submit your roadmap from week 3. BFI, buyer's agency agreement and roadmap must be submitted 48 hours before your one-on-one, all in one email, no exceptions, in order for an agent to review in preparation for your one-on-one. Please be aware, while one-on-one appointments and buyer's agency agreements are not required in order to complete this online workshop, only our participants who have completed this step will be considered graduates of the Sarita Brown Academy at the end of this 6-week program. We encourage all participants to continue with the course regardless of your choice. We are here to answer your questions and support your journey. Congratulations on completing week 4. It's homework time.